Pramod Gubbi, Managing Director and Head of Institutional Equities at Ambit Capital, joins us on the show. Pramod, I want to start off with that note. You know, there's so much of rumor mongering about what could happen as a measure of populism, which would be out and out bad for the fisc. Now, this whole talk of fuel price deregulation, then a talk of pinching the upstream companies substantially. Day before yesterday with sugar, wherein the numbers of 20,000 crores were doing the rounds of a package. On almost all of the counts that at least I remember over the last 12 months, yes, there could have been certain measures taken, but nothing which is so out and out outrageous that you would question the impact that such measures could have on the fisc or the measures like deregulation that the government has taken.
Yeah, I'm not sure what would classify as outrageous, but what is clear is certainly we'll see a slippage on the fiscal deficit. It happens pretty much all the time ahead of an election year, irrespective of which party is in power. And more so this time around, I think the distress in the rural economy, while we've had a decent last monsoon, given the subdued crop prices, there is genuine distress in the rural economy, and you could argue in some ways you can justify some sort of development spending, relief spending in that area. So in that case, I guess the biggest spend worth watching out for is the MSP announcement coming later this month. It won't be the last, but I guess it will clearly set the tone. I guess in some ways the sugarcane relief measures has already set the tone as to what to expect over the next 6 to 8 months. But I think the biggest one, which is more structural in nature, will be the MSP policy that will be announced later this month. So in some ways, the slippage in the fiscal deficit is a given. Whether it's outrageous or not, we'll have to wait and see.
Let me qualify my term, Pramod. By outrageous, I meant if the total arrears are 22,000 crores and the government says, okay, the number may be large, but we are giving out all away because people believe it's an election year and we need to win elections, and therefore this is the way to do it. So they didn't do 22,000 crores, they did 7,000 crores. They could have pinched the upstream companies in a meaningful way. That was the talk of town. In fact, it was almost a given in certain circles that the announcement would have come in last Thursday night, and Friday morning we'll be talking about it. Nothing of that sort in a meaningful way has come about at all, while it's been the talk of town around. And that's what I mean. There will be certain things that you would have to do in order to alleviate the distress in the rural space. But that's what I mean by outrageous. We're not seeing exorbitant sums of money being doled out a year before the elections.
Yeah, I mean, I don't think not yet. Not yet.
Okay.
There is still about 6 to 8 months to go, which is why I'm saying that the sugarcane relief was a beginner of sorts. Perhaps the MSP will give a better direction. It's worth waiting for the next 2 weeks. But also on the revenue side, I think given the numbers from GST, it's still not clear how the revenue side will pan out because GST is still a new phenomenon. We don't really know the seasonality in it, whether there will be a pickup in those revenues later in the year as well. So both on the expenditure and revenue side, I think we'll have to wait and see. But I would think a 20-30 basis point slippage in the fisc is something that we should pencil down anyways.
Pramod, what do you make of the RBI commentary that we saw yesterday, especially given that they went ahead and raised rates, but they're maintaining the neutral stance, and they're saying they're adapting a wait and watch method?
Yeah, I think in some ways the RBI is perhaps underestimating the inflation trajectory. Again, perhaps they're also waiting for the MSP announcement, which will play a big role in how inflation picks up over the rest of the year. If the MSP increases are significantly higher, hearing 20% plus, then obviously given food being a large part of that basket, will feed into consumer inflation, and clearly will overshoot the RBI's estimates, and hence the RBI will have to get a lot more hawkish. So I think if at all the RBI is underestimating, but perhaps it's better to wait for some of the announcements yet to come from the government before making a clear call on to what extent they need to change their hawkish stance.
Right, Pramod, I'm going to shift focus to consumption then. As a house, you guys have been, relatively circumspect when it comes to some of these large names and staples such as HUL and ITC. And I understand you can't talk about stocks specifically, but how are you viewing the larger cap stocks out here in this basket?
In fact, on the contrary, we've been quite bullish on consumption. In fact, large cap consumer names we've been bullish over the last year or so, exactly for this reason. Partly we finally saw some sort of volume growth picking up post demonetization and the GST headwinds, given the supply chain shocks that the sector had seen. But also in terms of the increased spending by the government, normal monsoons, hopefully a pickup in rural as the spending picks up. Will all feed into FMCG top line growth, and some of these firms are pretty strong in terms of brands, and hence even in the wake of the input cost inflation that we're seeing, if at all these guys are best positioned to sort of preserve some element of pricing power and hence margins. So we reckon finally volume growth is coming back, and that should feed into earnings growth for these companies. Having said that, of course, valuations are not the most attractive, and we are taking a little bit of a circumspect look. They've done really well in terms of stock price performance, but earnings growth is still perhaps the most predictable across other sectors, in the large cap space at least.
What's the Pramod? What's the top draw as far as earnings growth for FY19 goes, now that you've dissected what's happened in FY18 by and large? I mean, your formal note, I don't know whether it's out or no, but what seems like the best bang for the buck, purely from an earnings growth perspective from the next 1 year or the next 2 years?
I think private sector financials will continue to lead the way, particularly the banks with strong CASAs. We clearly, in a rising interest rate environment, we can expect yields to go up, and some of these banks with strong CASAs will be able to protect the cost of funds and hence capture most of the yield increase into their margins. And we all know the story on the loan growth side, where they continue to gain market share from the PSU banks. So with a very healthy top line growth and expanding margins, you can see earnings growth disproportionately higher for some of these private sector banks, particularly the retail focused banks, and I don't see any reason why they shouldn't continue to lead the pack in terms of earnings growth. Secondly, I think FMCG, like I mentioned, it is an election year. Consumption will be strong. Companies with pricing power will be able to protect their margins, and most of that consumption demand will flow into the bottom line, and they should also lead in terms of earnings growth.
Okay. Pramod, the other point is, what do you think about commodities? I would have wanted to ask you about specific pockets in the mid-cap space, but I'll avoid that. I know you can't talk stock specific, so let's talk about commodities. What's the base case view here? They've been slightly choppy the last couple of months, and understandably so. I think the base commodities too have been choppy. But what's the year-round outlook, and whether you're telling your set of investors who may have been earlier investors to stay invested within the ferrous, non-ferrous space?
Yeah, commodities haven't been, particularly a strength given the global nature of these and the various moving parts. But our sense is, given how healthy global demand is, global growth is across developed markets and emerging markets, unless we see some sort of a significant shock by one of these central banks taking an adverse action on the balance sheet unwind, we reckon the global economy is in a fairly healthy space. That should augur well for commodities, both in terms of commodity pricing and stock prices for commodity producers. And the same thing in India as well. India is also on the recovery trajectory as far as economic growth is concerned, and that should augur well for local demand as well. So I don't think we'll have anything drastic to say in terms of potential negative catalyst for commodities.
Okay, but Pramod, yesterday we had Infosys, talk to one of the other broking houses in the conferences. But I want to talk about the industry in general, and the theme that the management was talking about was an integration of digital services with traditional services. That's what we're going to expect from some of the relatively larger companies in the Indian IT space. The question is, how soon can they bring in this integration, and in that case, how does that stand out? How do the large cap companies stand out in comparison to some of the relatively smaller ones, which have seen, well, a little bit of an outperformance on a year-to-date basis?
Yeah, when you look at transformations of this degree, you would expect some of the larger guys to take that much longer to adjust. It's always easier for the smaller guys to be a lot more nimble and make these adjustments much faster, which is what we've seen so far. Some of the mid-cap names have adapted, particularly those who had some legacy skills in this area have adapted much faster, and that's clearly showing in terms of their performance, not just in terms of the stock price, but also the fundamental performance has led. But having said that, I think the large cap guys have spent a lot of time and money investing in acquiring or developing these skills over the last 3 to 4 years, and we're seeing the beginnings of them putting that to use in terms of gaining some early contracts, early orders, and arrest the sort of loss in market share that they saw to some of the global majors. So we can expect a pickup in top line growth for some of these guys, also aided by a tailwind that there is a pickup in global IT spend as well. And alongside that, if we see continued pressure on the rupee, that adds nicely for the large cap IT stocks. I mean, they may not get back into the 15 to 20% top line growth, but even a 10-12% top line growth with a little bit of margin expansion coming from currency depreciation can help get them to a 15% plus earnings growth trajectory.
Okay, Pramod, we'll leave it at that. Many thanks for joining us today and giving us your views, and well, have a great month ahead.